The S&P 500 review, we're going to actually see what has been the best performing stocks as well as the worst performing stocks this year so far, as well as some key important data for the market. So starting with Wall Street's forecast, at the end of 2023, Wall Street strategists significantly underestimated the S&P 500's potential for this year. Most targets hovered around 4,600 and 5,200, well below the 5,970 level reached by December 27th of this year. By October, 19 of all of the analysts that Bloomberg follows had actually adjusted the levels between 5,600 and 6,000. Here on this chart that we see from Bloomberg, we see on the black dot what was the target from December of 2023 for December of 2024 from all of the major banks and financial institutions on the world, and the pink one shows the updated one. None of them were actually even close to this year's target. Also, no surprise that we've had a high concentration in the market. Surprisingly, now 10 of the largest stocks in the S&P 500 now represent almost 40% of the index market cap, while 34% of the S&P 500's value comes from just 8 stocks, basically the Magnificent 7 plus Broadcom, which are Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, Google, and Broadcom. This chart, also from Bloomberg, very interesting, shows how heavily concentrated the market is. 10 stocks account to almost 59% of the S&P 500's gains since the bull market started in October of 2022. The next 10 stocks actually represent 11% of the gain, and the rest of the index represents 30% of the gain since the October's lows on 2022. Also, a rare winning streak for the market. The S&P 500 is on track to have back-to-back annual gains of at least 20% for the first time since 1999. Since 1950, there have been 8 times where the S&P 500 gains were 20% or more 2 years in a row, and none of the 19 strategists actually right now tracked by Bloomberg expects the S&P 500 to decline next year. So this is also a very bullish. Good job for the bulls who actually crushed it this year and last year as well. Also, this is the historical returns for the S&P 500. Out of the past 6 years, only we've had one red year, 2022, while the average gain over the past 10 years has been around 10.5%. Now we're going to see what have been the top 5 S&P 500 stocks this year. Starting with Palantir, no surprise, with a gain of 360%. The main reasons why Palantir is up so much, well, because of AI integration. Palantir's advanced AI-driven data analytics solutions attracted significant commercial interest, leading to a 30% increase in its past quarter, third quarter revenue to $726 million. Also, really well taken by investors, the government contracts. Palantir secured $1.16 billion in government contracts, as well as its S&P 500 inclusion. It got added to the S&P in September, and a profitability milestone. It's their most profitable quarter, achieved a net income of $144 million in the third quarter of this year, marking sustained profitability. And what are Wall Street analysts saying? We see here in this chart, out of the 16 Wall Street analysts that covered Palantir, they have a neutral stock rating. Its highest price target is basically currently trading at 80, average price target at 44, and the lowest at 11. Palantir is currently trading basically at 79, which is really weird to see out of these 5 stocks that we're going to see. It's the only stock trading way above its average price target. Vistra, second best stock on the S&P 500 with a gain of 262%. The main reasons why it's up so much as well with AI. This is the year of AI. AI data center demand, the anticipated surge in electricity consumption from AI data centers projected to add 35,000 million watts by 2030, positioning Vistra favorably as more companies are actually moving to use nuclear energy for them and their AI needs. Also, their nuclear fleet expansion. They currently are owners of the second largest nuclear fleet in the US, which supports increased power generation capacity for the upcoming companies that are willing to actually use nuclear energy for them. And their market leadership. As the leading US power producer, Vistra capitalizes on rising electricity prices and demand, driving its stock performance. It is not much covered, only 8 Wall Street analysts covering Vistra with a strong buy rating. Its highest price target, $231 per share, average 179, and the lowest one at 151. It is currently trading way below all of these 3 targets at $139 per share. Third, Nvidia, with a gain of 176% this year. Well, no surprise, AI dominance. Revenue soared amazingly with 170% year over year for its previous quarter of the third quarter of this year to $18.1 billion, driven demand for AI chips like the H100, priced at over $25,000 each. Also, the data center growth, amazing numbers. Data center sales grew 210% this year, fueled by AI adoption and cloud providers upgrading infrastructure and their market leadership. Right now, NVIDIA maintains over 80% of the market share of GPU space and AI machine learning applications, as well as with a really good, well-stocked performance. It is the first time NVIDIA actually surpasses the $3 trillion market cap. What are Wall Street analysts saying? Well, out of 40 Wall Street analysts covering NVIDIA, has a strong buy rating, the highest one at $220 per share, average price target of $177 per share, and the lowest one at $135 per share. It is currently trading at $137 per share NVIDIA. Fourth stock, United Airlines, $141% gain this year. Well, and the main reason is because of international expansion. They have been focusing on long-haul international routes, capitalizing on strong demand and high revenue potential. Also, the fleet renewal. They invested in 270 new Airbus and Boeing narrow-body planes and 150 new wide-body Boeing 787 Dreamliners, enhancing the operational efficiency. And the financial strategies, they also implemented a well-received by investors 1.5 billion shares payback, reflecting strong financial health and boosting investors' confidence. And what are Wall Street analysts saying? Well, out of the 16 Wall Street analysts covering United Airlines, they have a strong buy rating on the stock. Highest price target, $150 per share, average $114, and the lowest one at $85. United Airlines is currently trading at $99 per share. The fifth one, GE Vernova, one of the strongest Sharp ratios stocks out there with a 138% gain this year. Well, they actually started this year with their spin-off success. Since their spin-off that happened on April 2nd, the stock has actually surged more than 200%, benefiting from a clean balance sheet and no debt. Electricity demand growth, as well as Vistra, they are positioned to capitalize on increasing electricity demand, especially from AI data centers, enhancing growth prospects and analyst confidence. Approximately 76% of analysts rate the stock as a buy, with price targets ranging from $355 per share to $420 per share. Currently, are 21 analysts covering GE Vernova. The highest price target, $420 per share, average $369 per share, and the lowest one at $355. GE is currently trading at $338 per share, so it's still looking pretty strong. Now we're gonna go into the worst 5 stocks on the S&P 500. I would like to know, what are you all planning? There's a lot of speculation saying that because of the tax harvesting loss, this could be good contenders to actually buy for 2025, although it is not financial advice. Starting with the worst performing stock on the S&P 500, Walgreens, dropping 63% this year. The main reason is because of store closures. They announced plans to actually close 1,200 stores over the next 3 years as part of a turnaround strategy, indicating operational challenges. Also, financial losses. They reported loss due to goodwill impairment charges and bad equity investments with underlying business issues. And the stock performance. Shares have actually declined over 60% this year, making it the worst performing stock this year. Only 13 Wall Street analysts cover the stock. The highest price target at 14, average price target at $9.3 per share, and the lowest one at 7. Walgreens is currently trading at $9.6 per share. The second worst performing stock, Moderna, dropping almost 60%. The main reason is because of revenue drop. The total revenue in this third quarter for this year dropped 30% to $241 million, primarily due to declining COVID-19 vaccine sales. Also, they had some pipeline cuts. They reduced quite significantly their R&D budget by 20%, cut 5 drugs candidates, and scaled down drug approvals from 15 to 10 by 2027. Right now, their stock is almost down 60%, reflecting the stock and also the investors' waning confidence in their products and their business. It is currently followed by 19 Wall Street analysts with a neutral rating. Highest price target, although this is good news, at $112 per share. The average target from Wall Street analysts at 62 and the lowest one at 31. So even though it's down so much, it might actually be interesting if these analysts were to be right. Third one, Intel, same as Moderna, dropping almost 60%, 59%. The leadership changes. The recent departure of the former CEO, Pat Gelsinger, has created uncertainty about the company's future direction. Also, really bad news, and you don't want to see never this, especially on an S&P 500 stock, a dividend suspension. Intel actually announced they're going to be suspending its dividends starting in the fourth quarter of 2024 as part of the $10 billion cost-cutting plan, raising investor concerns. And the stock performance, well, It's actually significantly underperforming the PHLX semiconductor index, which rose about 22%, while Intel is down almost 60%. And out of the 27 Wall Street analysts that are following Intel, has a neutral rating with the highest price target of 28, average price target of 24, and the lowest at $20 per share. It is currently trading at 20. And fourth, Celanese dropping 55%. Revenue declined for the third quarter of this year. Revenue fell by 2.8% year over year to $2.65 billion, driven by reduced demand across markets. Also, they had an earnings miss of earnings per share at 2.44, missing analyst expectations of $2.85 per share. They also, as Intel had a bad news of a dividend cut, they basically cut entirely their dividend by 95% to 0.07 cents per share to preserve cash and a weak demand. The CEO recently said that they're struggling with declining demand in automotive, paints, coatings, and construction sectors. It is currently followed by 18 Wall Street analysts. Its highest price target at $130 per share, average price target of 91, and the lowest at $73 per share. Celanese is currently trading at $68 per share. And last, to finish this, ST dropping almost 50%. Because of weak demand in China, sales in Asia region declined by 11% year over year in its fiscal year of 2025 first quarter, following a 6% decline in the fiscal year of 2024 due to sluggish consumer spending. They also have bad news by dividend reduction. The company slashed this quarter dividend from 0.66 cents to 0.35 cents, signaling financial strain and impacting investor sentiment. And also leadership transition. Their current CEO, Fabricio Fredas, is actually gonna leaving the position in January for a new CEO, which has introduced a little bit of uncertainty regarding the company's strategic direction, similar to what happened with Intel. A lot of nervousness around direction. But what are Wall Street analysts saying? Well, out of the 24 ratings, has a neutral rating, highest price target of $107 per share, the average price target of 81, and the lowest one at $61 per share. Estée Lauder is currently trading at $74 per share. So what do you all think these stocks? Do you think they have potential, the losers? And the winners, do you still think they actually are good contenders for the next year? Let me all know on the comments below, and I hope you liked it. Thank you.